Okay, great. So, again, I met some of you in person and online this morning. Rob Suffoletta. I'm a partner at Wilson Sonsini here in Austin, Texas. I specialize in corporate and securities work, mergers and acquisitions, and venture capital transactions. And what we wanted to cover today is just to kind of go over an outlook on the venture capital. We're kind of getting close to the end of the first quarter here. Most of this data is based on Q4 in 2022, so we'll go through that relatively quickly, and then we'll basically talk about the Silicon Valley Bank. As Marty mentioned, I'm literally on the phone and tracking down emails on that kind of as we speak, so we could give you some real-time information there. So from an agenda standpoint, we'll talk, kind of start off, just kind of give a big picture on fundraising, talk about SVB, talk about the capital markets outlook and the impact that's having on the venture capital market, talk a little bit about trends and deal terms, and then we'll talk a little bit about trends that may be coming down the road. So in terms of financing, and again, for those of you that are in the business, this is something that's going to be no surprise, is that we last year, in the late stage companies was especially tough, and there were substantial headwinds. So I guess the reasons for that are the later stage companies, also referred to as unicorns. They're very closely tied to the public markets. So for these late stage companies, when you're raising money at these, close to $1 billion or above $1 billion valuation, they're being priced essentially the same way that the public markets are pricing deals, with, of course, some discount for lack of liquidity. But when the public market multiples collapse like they did across the tech sector, including in the SaaS area, that has an immediate impact on late stage companies raising money. So last year, both the value of the deals and the number of deals both went down. When you go to the early stage, definitely there was still a decline in the early stage transactions last year, but things were a little bit better. Again, the theory being that with the earlier stage companies, there's more runway, and they're not as tied to the trends in the capital markets. Although certainly early stage Series A, B investors are also looking to the strength of the capital markets when they're deciding to make investments. And then if you go all the way to the very early stage companies, basically through the end of last year, those were relatively strong. And that's kind of continued into this year. We have seen many companies obtain, early stage, seed financing, convertible note financing, safe financing, and Series A. And so I would say valuations have been a little bit rocky. We're seeing a lot of extension rounds or rounds with flat valuations. We also are starting to see a few down rounds, but in general, the money is still available in the early stage companies. So transitioning over to SVB, and I know there's been a lot of discussion about this already on other panels, so I'll try to look at it from the company perspective and the tech company perspective. So as I think everyone knows already, the depositors are going to be made whole, and the FDIC has established this bridge bank, which is returning Silicon Valley Bank to its normal operations. There have been letters that have gone out to clients of SVB from the new CEO, and he has given very strong assurances in those letters that the bank is open for business and it will be business as usual, both in terms of being able to get money out, put money in, draw down on loans, or maintain existing loans. I think because of this, at least in the short term, many people, including many of my partners in our debt group, feel that SVB is one of the safest places to keep your deposits right now on the banking side because of this government backstop. So how long that will last, we don't know. But given the government guarantee above the $250,000 FDIC limit, the deposits appear to be very, very safe at this point. We have many companies that are asking the question about, or have tried, and some have actually done so in terms of pulling their money out of Silicon Valley Bank. So basically, the standard way that a Silicon Valley Bank loan has been structured with the tech companies is that there's a loan agreement that's put into place. One of the requirements of the loan agreement is that the company maintain all their deposits at Silicon Valley Bank. Silicon Valley Bank would typically loan money shortly after a venture capital financing. So say a Series A or Series B round, and they would typically be willing to do a loan agreement equal to approximately 30% of the round, price plus or minus. And then it would require warrant coverage, usually, 15, 20, 30, 40, 50 basis points of the company's fully diluted capitalization. And the interest rate would typically be, quite reasonable, prime plus, 1%, give or take, 50 plus basis points. So, so because of these loans that are put in place, again, usually after a venture financing, then the companies will keep their money in Silicon Valley Bank, and that's a requirement of the loan agreement. So for companies that have pulled money out of Silicon Valley Bank, in almost all cases, they are in default of their loan agreement. Now, if they have not drawn any money on their loan, then the remedies to the bank are not that significant. That they're even though they're in default, and they would be prohibited from borrowing money. The bank doesn't really have any reason to go after their assets or anything like that because there's no balance on the loan. If there is a loan balance, then the implications of withdrawing funds and being in breach of the loan agreement are obviously more severe. Now, interestingly, the standard Silicon Valley terms of bank loan terms is there is typically a 10-day grace period for these types of defaults. So for companies that have pulled their money out or are thinking of pulling money out, they do have an opportunity to essentially put the money back, some or all of it, and get back into compliance. So what I'm seeing, literally just this morning with clients is that some companies are very negative on venture debt. So in terms of future financings, the venture debt market, a lot of venture capitalists that I've talked to even this morning, both on the East Coast and the West Coast, are becoming much more cautious about venture debt. I think for companies that have pulled money, some or all of their money out of SVB, I think frankly they're rethinking that because number one, you get the FDIC guarantee in the deposits, and number two, if they have an existing loan agreement with SVB, frankly, those terms are something that's probably favorable to the company, especially as this market environment continues to evolve. And certainly it's expected that the terms of venture debt will become more onerous for companies. So if you already have an agreement in place with SVB, I think a lot of companies are thinking hard about just leaving those agreements in place. Some companies are even thinking about drawing down on the loans. As basically looking at it a way that's more attractive than what the alternatives might be.
Rob, are you talking about, so bank lines of credit are still available?
Yes.
Wow.
Yes. So the bank is open for business as usual, and they have notified companies that they're available to draw on the loans.
Wow.
Why are the VCs souring on venture debt?
I think that they were caught by surprise by all of this. I mean, just a couple of data points. The 52-week high for SVB stock was $5.97. Now it's 0. 22 out of 23 research analysts that were covering SVB had buy recommendations on the stock in February. And the famous or perhaps infamous Jim Cramer had recommended SVB strongly on CNBC just last month. So I think, again, this is like an initial reaction. And I think there are some VCs that have always been a little bit skeptical of venture debt because, again, many of these companies, are not profitable and they're not necessarily generating a ton of revenue. So they don't really have the cash flow to pay back the loans. So I think that some venture capitalists have definitely been a little bit apprehensive of venture debt in general. I think now with this kind of shock wave of, which has now been largely remedied, but this shock wave of having funds frozen, I think has soured some folks on it even more.
Isn't there an issue around all of a sudden having, I don't know, the federal government on your capital stack? Right, I mean, because all these, warrants and equity that Silicon Valley Bank has is gonna go away to somebody else. Right, so now instead of having one entity who's been in institution for 40 years, you're gonna have several, definitely malevolent, private equity firms, other firms, et cetera, buying up these equity shares.
So I think that's an excellent point. The FDIC has indicated they are still seeking buyers for the bank. And, rumor has it that there was an auction process over the weekend, wasn't successful, but it's definitely expected that, that they're not going to be in this business forever. Normally these bridge banks, are something that lasts, 30, 60, 90 days. So I think everybody's expecting that the bank will either get bought as a whole or in pieces. So Marty, so you raise a good point, because again, it's one thing to have SVB, holding warrants and SVB on the other side of the loan, but at this point it's very uncertain. So I guess best case for companies is that another, well-known bank or a bank that knows the technology space will just take over SVB and really continue business as usual. I don't know what probability to put on that. Another avenue would be that a larger bank buys Silicon Valley Bank. Again, they may not have the same view of how strongly to pursue technology, venture lending. They could decide to do things a lot more tightly, like the bigger banks tend to do. And then the third potential buyer would be some type of company that's not really in it for the long term. Somebody that goes in, basically tries to, over a period of years, wind down the portfolio, not going to be making a lot of new loans, may tend to be more strict on breaches. Most of these agreements have some sort of MAC clause, so you could get a potential buyer that goes in, takes a harder look at that, is tougher on companies, and does not let the companies draw, or maybe calls defaults.
Is it possible that the assets can be broken up among many entities?
Absolutely, absolutely.
Because that causes like a catastrophe on secondaries. Right, so if entities come in, they get the capital for a very low price, and then they can get more for it on secondaries markets. That's really bad for the VCs on the other side of that, right?
Yes, potentially, and there's definitely stories out there about some entities wanting, like, the wealth management business and other parts of Silicon Valley Bank. So there's a chance that the loan business can kind of get separated, from other parts of the business, which again would have kind of big implications, going forward. So, as I think everybody knows, there's a total loss for the SVB stockholders and investors, even though the deposits are safe. We already talked about the potential acquisition and who the buyer would be. But I think it was mentioned on one of the earlier presentations today, at a minimum, this does eliminate a very tech-friendly source of early-stage debt capital. It seems extremely unlikely that any existing bank in the tech space is going to immediately zoom in, drop in, and kind of try to get all this SVB business. And it also seems very unlikely that whoever buys SVB is going to have the exact same culture and lending profile and relationships with the tech firms and the venture capitalists that SVB did. So at a minimum, you're eliminating probably the key source of early stage debt capital. There clearly will be companies that try to move into this space. I've been, and my clients have been, getting emails already about people who are wanting to come in and try to arrange other lending. So Marty, I think you mentioned to me the other day that of a company who's been in the business but is now looking to expand that. So there will be companies that step in and try to take advantage of this void. But again, nothing's going to replicate SVB, and the ecosystem is going to take quite a while to heal itself, even if other players try to come into
the SVB scaling was because it was a bank. Right, because it could tap lines of credit and create these loans, whereas any other venture debt fund, you're charging 18-20% rates,
right, exactly.
Versus 1 plus.
Yeah, prime plus one.
Prime plus one, right? I mean, It's remarkable.
Absolutely. So because of this change in the ecosystem, definitely, coupled with the, not great outlook in the venture capital funding market, especially for, at mid stage or, early stage, the market's been better. But because of that, the difficulty of raising funding, which we'll talk about in a minute, coupled with the, more difficulty in getting the debt funding, it's really going to put the squeeze on companies. Basically, they're going to have to make the cash they raise last longer, extend the runway, lower the burn rate, or they're going to have to raise, more money at potentially, valuations that they don't deem to be attractive. I'll just touch on this briefly. I mentioned it earlier, is because of obviously the IPO window, slammed shut last year and is still slammed shut. Conventional wisdom is it might open up in the second half, although I'm starting to hear more like it's now Q4 or Q1 of next year. So again, as long as the equity capital markets, remain difficult for IPOs, that's going to continue to have an impact on the ability of these later stage pre-unicorn or unicorn companies to raise capital.
I love that.
So just want to touch on some trends in deal terms. So as I mentioned, Q4 data continues to show a challenging environment. The number of down rounds has increased, so approximately 32% Series B or later compared to 8% in Q3. So pretty precipitous increase in down rounds. And valuations, Q4 to Q3, definitely valuations were down. In some cases, the amounts increased. The median amount did increase. But every deal is different. And again, we really don't have any data yet on what's happened kind of in January or February. But I would think we'd continue to see valuations go lower and amounts raised be flat to down. Another trend I wanted to touch on are the rights of the preferred stock.
Are you going to be able to share these slides?
Sure, absolutely. So, I'll share the slides, and also we have published 2 or 3 short newsletters on the Silicon Valley Bank situation that we've sent to clients. I'll make that available also through the portal. Also, we publish a quarterly review of deal terms, which is about 15 pages long. We just came out with our report for 2022 compared to 2021, and I'll make that available also to you and all the folks in your organization, Marty. So in terms of preferred stock, although the valuation and the amount raised are the 2 key terms, of course, I wanted to speak for a minute on other key terms. So in up rounds, the primary deal terms did stay investor friendly in 2022. So perhaps the most important term after valuation is liquidation. How the liquidation stack looks. And 70% of post-Series A deals in 2022 still had a pari passu liquidation, which is most favorable to the company and the existing investors. 91% of those rounds had non-participating preferred stock, which again is most favorable for the company and the common stockholders. And almost all deals had broad-based weighted average anti-dilution. So again, in up rounds, the terms in 2022 remained very friendly. Now, in down rounds, which again increased as we got into the second half of the year, and especially as we got into Q4, it's a different story. So 64% of post-Series A down rounds had a senior liquidation preference. So again, in the event of a sale of the company or an out and out liquidation, the new money coming in would get their money back first. Also, we saw a big uptick to 36% in the percentage of down rounds that had participating preferred stock with no cap, and that's up from 0% in 2021. So again, this makes the economics of the new money coming in the down round much more attractive for the new investors. And then we are starting to see some pay to play provisions. So again, only saw that in 17% of the rounds in 2021. That upticked all the way to 43% in 2022, again for down rounds. So again, a pay to play, is a mechanism where the new investors, whether it's new money coming in or whether it's existing investors leading the round, are putting in a very strong incentive for existing investors to participate. So the pay to play a typical pay to play would be that unless an existing investor participates in the new financing, usually up to their pro rata or some portion of the pro rata, then their existing holdings would have an economic penalty, most typically the preferred converting into common. So if you participate in the new round, your prior preferred and all the rights are protected. If you don't participate in the new round at the specified level, your existing preferred stock would convert to common stock, and you would lose all the liquidation preferences and other rights of the preferred stock. So just wanted to transition into the last part of my presentation, which is anticipating market trends. Just want to highlight a few things. So obviously in a strong market, the things that kind of characterize that type of market are, investors kind of, get the pitch. I mean, they hear it, it resonates. Investors believe in the growth potential. And, you typically see, multiple term sheets, short period to closing. The investors are anxious to see the money invested in marketing and sales. They're excited to see the company, increase hiring to scale the business. And the presumption is you can raise more money later at a higher valuation, when you need to, 18 or typically, 18 months plus or minus, down the road. Now, in a weak market, as we've seen Q4 and continuing into this year, you see much more skepticism by investors on the pitch, rightly so. Much more due diligence done on growth potential and other types of due diligence. The time to close and the time to get a term sheet, get through due diligence, it just that time period extends. An individual company tends to get fewer term sheets, and you tend to see more inside rounds. And many companies either have no choice but to do an inside round, or they're getting one term sheet, so they really have to negotiate with the investor that puts forth the term sheet, as opposed to having multiple term sheets to consider. When these rounds are closing, the investors basically are what they want to see is investing in R&D, slow the burn on marketing and sales, only hire top talent. So be much more careful and deliberate about ramping headcount. And then also it becomes even more important for the funding to be able to get you to an inflection point. Since you may not be able to raise money, if the market stays unfavorable, 12 or 18 months out, it's more important to make sure the funding you do get you to an inflection point where you're going to have a type of event, whether it's on the product side or the revenue side or EBITDA side, to get you to an event where you're going to be more likely to obtain funding because you've satisfied that inflection point. And then just wanted to give some final tips on how to prepare for this weak market. Again, from the company's point of view, very important to be clear on the value prop, especially for customers as well as the investors. You have to have the right team in place and also have, the so-called big Rolodex. So be able to demonstrate you can build a team, you can fill holes in the management team where needed, and continue to, so you can have people positioned and continue to grow the company. Definitely, revenue is key. Anything companies can do to get to early revenue or to ramp revenue is extremely important. Not only does it give you, more runway in terms of lowering the cash burn rate, but basically it helps validate, the business and, make the investors, the existing investors and potential new investors more confident in the business. A lot of times in a weak market, companies are going to have to be flexible on terms. For the investors in the room and on the call, the investors have the upper hand. Especially if you're the only term sheet in town. If you're an existing investor and you can't get an outside term sheet. But my advice to companies is, money obviously is the lifeblood of the company, so you have to be flexible, look at it long term, and negotiate the best terms you can, but be flexible in order to be able to get funding.
I'm gonna ask you a question again.
Okay. Obviously, due diligence, as I mentioned, it gets to be more thorough. So again, if you're trying to raise money, be prepared for that. That's something that if investors see companies that aren't prepared for diligence, that's just going to, at best, extend the process, if not kill the deal. And lastly, just wanted to give one note of optimism. There is still a lot of money out there to be invested. At the very late stage, private equity funds are flush with cash. Even in the early and mid stages, there is plenty of capital out there at these venture funds. Many venture funds raised, new funds in the past couple of years, and they're in the business of investing. They can't afford to just sit on the sidelines, but they can't afford, to be selective. They can't afford to negotiate, favorable terms. They can't afford to do extensive due diligence. But there is money out there to be deployed if it's the right business, the right management team, and the right growth profile.
So it sounds like you're saying like a return to fundamentals.
Absolutely. Absolutely.
I mean, so money's been very cheap for a long time. Seems like a lot of ventures is FOMO, right? And a lot of ventures lost discipline. And I mean, do you anticipate rates going down at any point in the near future to where they were, or you have any thoughts on that? Or because I think that will dictate, besides the failure of Silicon Valley Bank, that's going to dictate a lot of where venture goes, don't you think? Or what are your thoughts?
Yeah, so I would say definitely two things I would never predict are the stock market or interest rates. But I would say that conventional wisdom is, with the Silicon Valley Bank, the economy continuing to soften. Looks like inflation is down ticking slightly. I think the Fed's going to be under a lot of pressure to, I think a lot's changed in a week. I think they're going to be under a lot of pressure now to either stop rate increases or potentially even cut rates if the economy continues to sour, versus their prior plan of continuing to, ratchet up rates through the end of the year. And I think on the investor side, again, they have money to invest, but I think they're going to be deliberate and they're going to do, just more checking and be more patient in terms of serving up term sheet and closing transactions.
It's been a long run. I mean, we had a good number of good years, right? So
absolutely.
Everything that goes up comes back down eventually. But I'm just curious, from your time in the business, you've probably been in for a while. Thoughts on syndication and early stage deals, or any change that way historically when you see people trying to sort of get out of the wagons or go it alone?
I have always thought that syndicating deals is best for the investors and for the company. I think from the company's point of view, even in a Series A financing, if possible, you still want to have two solid investors at least at the beginning, because again, you're going to need B and C financing, and the more folks you have around the table who are invested in the company, potentially provide funding later, I think is always a great thing. That being said, I will say that, in the frothier markets, it's oftentimes easier to just get the one lead investor. And a lot of times the lead investors may not be as willing to kind of share or syndicate if they think it's an extremely hot deal. But I still think that, no matter where you are, in the food chain, having a strong syndicate, is the way to go, just because, the venture industry changes. There's, if you look back, 10, 15, 20 years, I mean, people move from fund to fund. There's new funds formed. There are funds that change their focus, or go in different directions. So I'd say from the company's point of view, and even from the investors, having a syndicate around the table where you can put together a deal, not just in easy times, but in tough times, I think is extremely important.
Do you think, private equity is going to start stepping in and start becoming a new form of exit that's gonna be favored for VCs that are trying to get back into these spaces, I guess startup, and then they could be one day the next venture capital layer?
I definitely agree with you. I think there's two key points there. So one is, for most venture-backed companies, I mean, the exit is the M&A. I mean, even when the IPO market, was relatively, robust a couple of years ago, well over a majority of venture investments are even successful ones, even if you want to limit it to the successful deals, are going the M&A route. And on the M&A, we've seen a ton of companies, selling not to strategics, but to private equity. So that's become a very, very important source of exits in the venture space, especially for companies that are, growing, revenue, EBITDA, et cetera, because that's obviously what the PE firms, like to see. And so I think that's going to continue. We've also seen, really for 10 plus years now is, private equity firms then selling to other private equity firms. So a lot of times companies will start off with venture, they'll get to a certain size, maybe can't scale to go public, sell a PE, and then that PE firm will put in money, maybe tweak the management team, and then maybe 2 or 3 years later, they're flipping into a larger private equity firm, which is maybe combining it, on a platform like Vista does, or maybe. Exactly. Yeah, exactly. So I think you'll continue to see that. And I think that's very essential to the whole venture capital ecosystem, is having those buyers out there, not just the strategics, but the PE buyers. The other point, the other question you asked, which I think leads to a good point, is, we are seeing, and I think you will see some of the later stage VCs or PE firms, dipping down into the earlier stage. Not heavily, because they're going to be restricted by their by their documents. If it's a late stage fund, they're not going to be able to put 50% of their portfolio into Series A deals. But I think you're going to see more funds because because of the disruption in the late stage market, the unicorn market. I think they are going to start to look for earlier stage deals, at least for a small portion of their portfolio. We've seen some of that.
I think most of the alternative managers have had spotty records dipping down in the venture. So if you look at the Tigers who have gone into it, they didn't do very well, right? So I think you have to say, what is it when they're talking to their investors, what do their investors think? Right? Because you may be a great growth stage PE firm, but when it comes to being an early stage, again, Tiger got into all this stuff, right? And their portfolio was wiped out. I mean, they got rid of it at the bottom. So
yes, I would agree with what Marty said, and especially the ones that have kind of dipped. So if you think of the ones that have mainly invested in very late stage, or even public entities, like the Fidelities and things like that, when they kind of dip down into that unicorn market, that's really got hit hard. What I'm thinking more of is the companies that are maybe the late stage, Series C players, maybe selectively looking, for a B deal or something, if they know the management team or know the earlier stage investors, and there's a good
very selective domain expertise.
Right. Exactly, and there's a good syndicate of firms in there already. They may tend to dip down a little bit and look for bargains they can get kind of in the Series B space.
Yeah.
Do you have any feel for the haircut we're talking about here in valuations? We're talking 30-40%. Just how would you quantify?
Well,
I know it's a hard thing to do.
Yeah, I would say, in the unicorn market, again, $1 billion and up. I mean, I think you've seen, valuations on certain companies, go down 50-60% or more. Again, similar to what's happened even in the public market. How many SaaS companies, which is a very proven, solid business model. How many of those public companies, are trading at 50% or less? So that same discount, plus a little bit more, is hitting the unicorn market. Now, again, if you're talking Series A financing, Series B, it's the percentage isn't that big because the valuations are lower. So maybe instead of a $50 million deal, it's 50 million valuation, maybe it's 40, but you're not going to see the discounts as big just because the overall valuations are lower. And again, the time horizon is much longer. Yes.
So question. So 40 years is a long time. Thank you so much for the insights. 40 years is a long time. So SVB really understood this market, the VC space, and they must have weathered so many different cycles of the market. What would have happened differently? Why didn't they not see it if they have done that proactively, that we are not in the reactive environment?
Well, I think that's the key question, because I think everybody is saying the same, asking the same thing you asked. Is this is not a new firm that got into the business 5 years ago and didn't know what they were doing. And they have certainly, they definitely, were a huge lender to tech business, in the 1990s. They survived the tech market collapse. They obviously, made it through the financial crisis, which largely, kind of impacted, the larger banks. But that's the big question, is how did they, not see this coming? Now, the interesting thing is, there's no evidence that I've heard yet that there's any issue with loan quality or loan defaults. So it's not that they, got overzealous and gave loans to a lot of bad companies and they get paid back. It seems to really be related to this yield curve situation. But even that, you would figure, I mean, in my mind, I say, well, first of all, if you're the 16th largest bank in the country, wouldn't you be, thinking about the implications of the inverted yield curve? And then also you would say, well, when the Federal Reserve is raising interest rates, don't they understand the banking system and the impact of the negative yield curve that they have on the banking system? So,
Well, I mean, it seems to me the one thing they could have done is charge a lot more on their rates for these loans.
Right.
Right, rather than one, prime plus one. I mean, because then they have more revenue and a more stable base. So, I mean, it looks like what their model was to make money on the back end. People went public, they had lots of deposits, et cetera, but then, what they did with the deposits, was not effective. So,
yeah, and I would say two other things that have had an impact. It's hard to figure out the exact magnitude, but number one, because the public markets have been shut down, companies like that had borrowed or had deposits. Let's say they hadn't even borrowed from Silicon Valley Bank, but they had their money there. Since they weren't raising new money, they were slowly drawing down their deposits. Not in any rush of the bank, but just because they needed to draw down their money to just pay their their operating expenses. So that was definitely a factor. And again, I don't know the numbers, but my understanding is that was pretty significant. Even before kind of the run on the bank, it was a pretty significant drop. And the other thing is, as Marty alluded to, with the public markets being, IPO window being shut, they're not making any money on their warrants. And again, they were invested in every such a broad base of companies. If the IPO market was stronger, it doesn't take many IPOs, when you have warrants, at kind of low prices. It doesn't take many IPOs to, throw a lot of cash on the balance sheet of the bank. So and that really dried up, the last, 12 plus months.
Do you think US startups are, looking at this perspective and saying, this market is really tightening right now, that they would actually look towards other markets for their, startup, VC rounds? I've been told many times during South by actually that particularly my end capital will be in UAE, Dubai, Saudi Arabia, those things. Do you think that it's going to become like a more macro trend of, maybe going with a Andreessen and taking that name and then going to that kind of market and finding the rest of the capital?
I think potentially, but that'd be a pretty big shift and a pretty big void to fill. So I think for the larger, later stage companies, they had already been doing some of that. So I think they would continue. I think if you're in the Series A, B, range, I mean, it's hard for me to see. I think opportunistically, like you say, someone partnering with an Andreessen might work, but I think your garden variety, VCs are don't necessarily have those relationships, and I think that the sovereign funds, that type of money, I don't think they're going to have a huge interest in investing in a really early stage. At some late, maybe a C round or certainly a unicorn round or something. We've seen some of that, and that may accelerate.
yeah, I think the whole model needs to be rethought, because it's not just SVB and their lending model, it's this deglobalization, which is reducing the number of investors. Right, all the Russians and Chinese have abandoned investing in U.S. venture capital. Right, and there was a lot of Russian investors in the United States venture capital. they're all gone. They've all sold off their holdings in the secondary markets at 70% discounts, right? So they're gone. So you got deglobalization. Is there really any capital in Europe that's not being spent on this war or other places, right? So then Middle East, but that's kind of a bridge too far for a lot of people, right? So I think that the valuations are going to continue to go down. I think there probably has to be some VCs that have to go belly up, or they won't have another fund. Which even in good times that happens a lot, right? A lot of funds fail if they fail to raise a new vintage. So, and then I don't think rates are coming down for any period soon. Because I think that there's a need to protect the dollar. Do you guys agree that there's that a 5% inflation rate is not something U.S. voters will live with? So that means fundamentals. Go back to fundamentals, right? And
Absolutely.
right.
There's plenty of capital in the markets, in private market, lots of dry powder, trillions.
Right, this vintage, but there may not be future vintages of that.
Yeah, but in the near term, it's gonna be a lot harder to compete. It's like all about competition and creativity, I think, again, but I don't know that other countries are gonna be our source of capital solution. But I think we've got a window to.
So you're saying there's lots of dry powder, but for a lot of the VCs who are investing, they're saying, is this my last fund?
Right.
And that's why they have to be very careful, because they have to get the return no matter what. And then they're also saying they want to wait to see valuations drop dramatically and see where the bottom is.
They're deploying less and less, is from what I understand and they're way more dry, but they're, not trying to get wet anytime soon, so they're not trying to dip their toe in.
It's more private equity.
I mean, weren't there like, 5 multi-billion-dollar crypto funds raised in the last 2 years? But I mean, who's investing into that space right now? It's going very slowly.
Yeah, and I think the other thing, with funds is, as folks know, I mean, not all that capital is available immediately. They do capital calls.
Right.
So, you raise a $500 million fund, you might call 15-20% of the capital up front. And then even though you have that dry powder, if your LPs start calling you up and saying, hey, I'm not happy with the way things are going, I don't want you drawn down until you have to. That puts pressure on the funds to slow roll, the investments.
So in November in 2021, SVB stock was $715.
Wow.
And even in February last year, it was $650.
Was the market cap?
Well, I mean, the market cap, last week was what was the market? 6 billion. So it was 7x that market cap. So it's 42 billion.
What role did social media and just the speed of communication cause this thing? I mean, the world we live in now. I mean, I'm not gonna blame Peter Thiel for anything. I'm just saying,
Yeah, I mean,
when you're out there like speaking, it's a smaller world, put it that way. And the role of communication has to affect this versus 20 years ago, meltdown in 2000.
it's the speed of information.
I think the spread of fear. I think the spread of fear was faster.
What do you mean fear? I mean reality.
Well, I think was able to spread faster through all the new communications.
Yeah.
Around when people pulling their capital out.
They were all calling their friends and saying, hey, I'm going
I think that's why the Fed was so much quicker this time compared to 2008 because of the viralness.
Right.
Yep.
The virality behind it.
And I think common people are not understanding what this means to them, right? The banking system coming down, so what exactly has happened to them? They're already fearful, their money is already on the sideline, they think that, okay, banks, at least my money is safe there. Now they're questioning that, is my money safe there? Yes.
Yeah, I still question how innovative, and people talk about the innovation economy, but still question how innovative social media is, right? Or giving people the ability to, drive, 18-hour shifts in Uber, right? I mean, none of us are head of household jobs, right?
Yeah.
I mean, back in the day, Texas Instruments, Hewlett Packard, they created fantastic job markets. Apple, people have got the head of household jobs.
All the smart tech is done.
I don't think so, I think people are less innovative, right?
Yeah.
And I think there's a great opportunity in venture capital for reshoring, and I don't think people have really thought about it. Like, how do you gear up for all this reshoring and nearshoring that's happening? And I think there's a gap in thinking that hasn't happened yet. I don't know if you see funds that are focused on that kind of stuff. All this manufacturing is returning to the US or going to Canada or
Big
Mexico.
opportunity.
No, it's
And the feds are behind
Brookfield
it.
is talking about.
And there's
it.
tons of capital.
Decarb, reshoring, I mean, the reshoring thing, people have been talking about it for a year or two. It's, you know, because of the pandemic, I mean, it sort of set everything in motion. And then with the supply chains, yeah, I mean, so it's a whole, you know, secular global trend.
Yep. Anything else, Rob? It's really a fantastic presentation.
Good, well, thank you, glad to do it, hope the rest of the day goes well, and I'll make sure to get those materials